Hello everybody, Luke Gromen, FFTT. Hope everybody had a great weekend. Hope everyone enjoyed that Bills-Chiefs game last night. That was, it's a shame somebody had to lose that game. So at any rate, I'm going to jump right in here. First question's from Andrew. Can you explain more about gold's potential rise with oil in the coming years and what their relationship is or may continue to be? Sure. To oversimplify, it's unwise to store surpluses in debt that has negative real yields versus oil if you're an oil producer, right? So in other words, if oil rises 7 to 10% per year, let's just pick a range, because of peak cheap oil geology that we're seeing de facto, at the end of 7 years, the oil producer is going to have, if he stores his surpluses in negative yielding debt, on a real basis, negative real yielding debt versus oil on a real basis, that oil producer is going to have, in oil terms, about half as much oil as he did when he started. He's just better off leaving it in the ground. And so if they want to avoid that outcome, they need to buy a reserve asset whose value can also rise in real terms, so that at the end of that 7-year period of oil rising, they will be able to buy the same amount of or more oil with their surpluses. Otherwise, they're just losing. And that something historically has been gold. And that's why if you look over long stretches, gold holds its value versus oil. Dollars and debt don't. Okay, secondly, from Patrick. Luke, thoughts on why Bitcoin has been trading seemingly in line with tech stocks rather than as a flight to safety or value store like gold and silver? Do you see any catalysts that could help Bitcoin decouple from risk-on equities? I think ultimately it's over leverage that is driving it. I've been, as it relates to gold, I've been very surprised how well gold has held in given what real rates have done over the last several weeks. So the last several weeks with real rates bouncing as hard as they have off the lows, I would have thought gold would be down $150 to $200 per ounce. It hasn't been. It's actually up a bit. So I've been surprised how strong gold has been in the face of that. Ultimately, in my view, the key catalyst for Bitcoin and gold remain increasingly negative real rates needed for sovereigns to earn their way, to inflate their way out of high levels of sovereign debt post-COVID crisis. Also think the nearer-term catalyst will be an eventual capitulation by the Fed on rate hikes in 2022. Now, I think ultimately Bitcoin is still acting as an FX hedge, or as a hedge. It's a hedge of FX depreciation over time. It also correlates with the NASDAQ and long-duration assets and real rates, like I said. I think it's important to note Bitcoin is trading like gold did in Weimar Germany. It's trading like gold did in Argentina, Venezuela, Turkey more recently, which is to say, even in Weimar Germany, when the German, as the Reichsmark was going, basically hyperinflating away to zero against gold in one of the great hyperinflations of all time, there were still 4, 5, 6 times where on a month-over-month basis, when the German government said something political about austerity or whatever they were doing, the German Reichsmark rose significantly against gold. Gold collapsed against the Reichsmark as the Reichsmark was ultimately going to zero against gold. And so I'm not saying that gold is the dollar is going to hyperinflate like Weimar Germany. That's not my base case. I think it's a very big tail risk. I do think that the U.S. is well along the way to Argentina with U.S. characteristics, and I think we need only look around to see the evidence of that building almost on a monthly basis over the last several years. My point, though, is that you got to stay conservative with your leverage. Like I said, even in one of the great hyperinflations of all time, somebody who borrowed too much, bought gold against the German Reichsmark, lost it all 4, 5, even 6 times in 3 years. Okay, next question. From Diaz, favorite non-Bitcoin or gold investment with a 5 to 10 year time horizon? I would probably say a combination of a basket of oil, copper, and agricultural assets, along with commodities that benefit from electric vehicles. And there's some ETFs that you can buy that are electric vehicle related ETFs, I believe. If you're looking for low carrying costs from a tax perspective, it's hard to beat farmland. Farmland is very rich right now in terms of pricing relative to crop output, but historically, U.S. farmland has correlated with U.S. M2 money supplies over time. It has a real yield that adjusts with crop prices. And we've been talking a bit more about water in the last 3 months. Water, I think, is going to be increasingly critical. The easiest way for a layman to play water is to own farmland. Basically, importing food is just importing water, a derivative of water. And so it's especially, I think, a good way to own water because I don't think people are going to be allowed to own water. I think it's going to be too politically sensitive. So I'll pause there on that one. From SMS, what are you doing to hedge yourself against the 20% decline in markets overall? It's a good question. I would say first, back earlier in 2021, I sold enough Bitcoin at $48,000, give or take, to pay off my house. And so for me, my thought was, look, if Bitcoin crashes from here, goes to zero and never comes back, or crashes and never comes back, then at least I got a house out of it. And so I don't think Bitcoin's going to crash and never come back. I don't think Bitcoin's going to zero. I continue to own a lot of Bitcoin. But I'm a conservative guy by nature, and this is just a way of de-risking beforehand. Haven't been through a few cycles before, just, hey, this is my worst case. Now I know my downside, I've defined my downside, and I can measure my upside, the risk that I have with what I still have on the table, so to speak. More recently, I've been letting cash levels increase, not really from selling anything, but just in terms of different businesses that we own have cash flows coming in. I'm letting those cash flows build up in the bank, and as they do, I'm looking to deploy them. I don't feel like there's enough blood in the streets yet still. I'll be watching for that to see, looking to basically deploy that money into asset prices, or into assets, gold, Bitcoin, commodity-related assets, industrials, with those funds, as I think we still have a little bit more pain to feel. From Rizzo, an explanation of the balance of payments equation would be helpful. You frequently speak of the U.S. running dual deficits and having a balance of payments problem. Sure. So the balance of payments equation is simply the current account deficit, which is your fiscal deficit, trade deficit, equals your capital account surplus, or vice versa. You run a capital account deficit, then you must run a current account surplus either via your fiscal or trade, or both. Trade surpluses or both. By design, the system that we have had since 1971 in particular is we sell assets to buy stuff. Lately, we've been selling a lot of U.S. tech stocks to foreigners to effectively finance our purchases of foreign goods and the United States government's fiscal deficit. The challenge, I guess, really is that if tech stocks fall or foreigners stop buying tech stocks, they likely can't or won't buy enough treasuries to balance the balance of payments equation, in which case the release valve to balance that identity will likely become the international trade value of the dollar. In other words, the dollar will fall to balance that equation. So hopefully that helps some of the framework that we've been talking about recently. From Odysseus, what do you think about Russia's announcement of a potential gold-backed stablecoin or crypto? Amidst the Ukraine warmongering rhetoric, is this Russia putting a shot across the bow and alluding to its US dollar trump card and threatening gold backing? I did see that article. I thought it was pretty interesting. In my opinion, it might be a shot across the bow. I don't know how the person who said it was a member of the Russian Duma, which, as I understand it, is their House of Representatives. And so I don't know if that was a senior person with a lot of clout, or if that was, one of the equivalents of a junior congressperson here who's just speaking off the cuff. So let's assume that they were serious, that they do have some clout. I think it's a really interesting point, because I think it's something that U.S. policymakers are just completely blind to, which is if they kick Russia out of SWIFT, this would be a nuclear reaction in terms of a response from Russia, but they could very easily just say, listen, we now value physical gold at 1,000 barrels of oil per ounce. It would instantaneously revalue Russia's massive gold reserves using Russia's own oil production, number one. And really, in oil terms, is really the only terms that really matters. Energy is the key resource. It's just the money is simply an expression of energy. And it would force the West to do one of two things: either revalue their gold significantly higher, in order to allow oil prices to stay economic for U.S. shale to produce, right? Because if Russia, the biggest energy producer in the world, says oil is 1/1000th of an ounce of gold, in the United States, right now, oil is 83 and gold's 1,800. So you're talking, right now, oil is 1/22nd of an ounce of gold. So Russia's oil would be way cheaper than shale. So either the West would have to revalue gold way higher, thereby having significant impacts on the structure of the global dollar system, or the West would see oil prices collapse to 1/1000th of an ounce of gold, or 1,800 divided by 1,000. So oil will go to $1.80. There isn't a shale well in the United States that is remotely close to profitable at $1.80 a barrel. Shale shuts down, and now we have oil supply problems. We're much more dependent on Russia because they have changed their pricing to undercut everybody else. So you can see strategically how that would play out. Like I said, I think that's a nuclear option for Russia. With that said, Iran moved to gold in 2012. Turkey moved to gold in 2012. UAE was selling gas in 2012 using gold. And so there is precedent for this. And again, that was after Iran got kicked out of the SWIFT system in 2012. So let's watch. Let's see. From CP, why does the financial media allow the Fed to lie about the CPI rate? I think it's understated, CPI. Why is that done? It's done by almost every sovereign historically. Domestically here today in 2022, the U.S. media thrives on access, not on reporting. And I think that's important to understand. So if they talked about the true rates of inflation or talked them up, it would result in the revocation or limiting of access to Fed officials, U.S. government officials, and that in turn would lose them credibility with their sponsors and their readers and their listeners, and that would hurt them in the wallet. And so that's why they don't. And why does the Fed and U.S. government work to undermine or understate inflation? Well, that's purely in service to the debt market, right? So lower inflation equals lower yields. And 25 years ago, lower inflation meant lower yields. That was a convenience. It was just a lower interest expense, no biggie, higher asset prices. Hey, great. Now, with U.S. debt to GDP this high and off-balance sheet liabilities coming on balance sheet because of the baby boomers retiring, it's a matter of national security to understate inflation. They absolutely need to understate inflation so that interest rates stay low, and it makes it easier to keep to inflate away the bond market. If you say CPI is 3 and it's really 8, and the bond market believes you that it's really 3, you're gaining 5% per year in purchasing power at the expense of bondholders, and that's what sovereigns do. So it is what it is. But that's why I think it happens the way it does. From RD, what kind of drawdown on equity market will cause Powell to roll over? What's more likely, concession to quell market fear, a pullback on rate hikes, or a pullback on QT? Also had a couple questions about how high is too high for the dollar. I think whatever decline in the market is enough to create rising treasury yields in a market decline, and or send the U.S. economic indices into recessionary levels. Practically speaking, I think that's probably down another 10 to 15% from here on the S&P, worst case. It is interesting today, you saw the ISM Services Index get borderline recessionary at a 50 reading. Now, that's not a purely clean number because of Omicron, so I don't want to get carried away with that. You're also seeing yields at the long end not do that great with the market down, the Dow down 1,000 points, whatever that is, 2.5%, 3%. So let's watch and see. It seems like maybe we're starting to bump up against that a little, but I don't want to get too carried away on too few data points. In terms of what level on the Dixie DXY is too high, I think it's probably 98 to 100. And that's whatever level starts to put enough pressure on foreigners that have dollar borrowings that they start to sell dollar assets, and it starts that vicious cycle downward of falling U.S. dollar asset prices, leading to reduced U.S. consumption, leading to reduced U.S. tax receipts, leading to increased U.S. borrowing against foreign selling, yields up as stocks go down. The dynamic, that vicious cycle we saw in March 2020 in spades, that was only broken when the Fed went to $625 billion per week in QE. And then finally, from Ryan, is sitting on a 10 to 15% cash a bad idea as we wait for the Fed theater to end? What do you think about taking profits and holding a strong cash position in these times? I think having 10 to 15% cash makes sense given what we're seeing. Like I said, I've worked cash up just not by selling anything, but by virtue of, as cash flow has come in from various businesses, allowing it to sit in the bank for the moment, not putting it to work as quickly as I was certainly a year ago at this time, where I was waving in a number of different types of assets, gold, Bitcoin, etc., stocks. So I will leave it at that. As always, thank you very much for joining me. It was great catching up. If you would like to see more information about these types of updates in a written form, check out FFTT Tree Rings. You can learn more about that at FFTT-LLC. Tree Rings, 10 most interesting things, little excerpts about why or how it fits into how we're seeing the world, or how it refutes how we're currently seeing or thinking about the world. Just trying to help build that mosaic, help the reader build the mosaic. So in the meantime, everybody have a great rest of the week. Have a safe week, and we will talk with you soon. Take care, everybody.